Thank you, and thank Winvesting for putting these MarketFest events on. This is, I believe, I'm not sure if it's my third or second. It's either my second, third, or fourth time being here, and I believe my business partner's been here before. So I want to thank them for putting these events on. I always like the events like this, and like I said, I like to come here and I like to listen to the speakers that are before and after me. The interesting thing is today I'm kicking it off, so hopefully we can wake you up a little bit, get you some good information to the markets, and kind of get going here this morning. So I do appreciate, I do like the fact that we do have people from all over the world. We've got people in different time zones, so thank you guys for making the sacrifice up front of your time. I do know it's going to be hard to pull away from the market at 9:30, but believe me, my job is to deliver not information that you can only benefit from at 9:30 today, but to generate, give you information that you're able to use throughout the rest of 2016 to make you money. So it would be great. I've got the markets on different screens. I'm sitting here looking at 8 monitors right now. It's going to be hard to get my attention to what we're talking about here at 9:30 when the U.S. market's open, but I'm going to make that commitment. So the one thing I will ask for you to do is to just make that commitment that one trade or 1 hour of your time is better spent learning what to do under different conditions, and as opposed to sitting here capturing the 100 or 400 or 600 bucks that you would make while we're talking here, because I want to be able to give you tools that make you that $100, $300, or $600, or $1,000, whatever your account can bear. I want to give you tools to make that money on a consistent basis every day of the week, not just today. So I do know that the U.S. markets are under a little selling pressure today, so I appreciate you guys taking the time out and investing in yourself, as opposed to sitting here trying to catch every little move in the market, because I will tell you that is a dangerous proposition if you try to catch every single move. We can pick and choose those high probability moves, like Dan talked about. I have built a cornerstone. My cornerstone in trading is being patient and waiting for the right moves with the positive expectancy. So that's what I'm going to spend the next hour and 15 minutes trying to give you guys some insight as to how I stack those probabilities in my direction. So before we get going there's a couple of little housekeeping issues that I want to take care of. This is the hidden secrets to index trading. What I will be talking about is exactly what the title suggests. Now, I took the 5 out of it. I know on the slide it's the 5 hidden secrets. The 5, at TradeTheSystem, we like to try to over-deliver. So I've got 2 bonus tips or tricks, if you will. So we'll be going over 7 clues to how you can stack the odds in your favor today. And basically what we're going to try to do is determine how strong the market is and in what direction it's likely to head. There's another little housekeeping issue that we've got. There we go. And that's the risk disclosure. So CFTC Rule 4.41 requires us to put this up here, and it says that I will be going over some past charts, and those charts will be hypothetical trades or simulated performance based on the woulda, coulda, shoulda kind of platform. We're not trading a live market today, but there are tools and things that we can use to analyze how we could make consistent decisions. And this presentation does not guarantee your success, and nobody here today will be able to guarantee your success. Also, that you should be using risk capital. Trading involves a certain amount of risk, and you should not be trading with money you can't afford to put at risk. With the risk, there is a great chance of returns, so you got to make that trade-off and talk to your financial professional or your portfolio manager if you have one, or if you are that person, you need to take a look at what is risk capital and what is not. And that's my duty as a registered advisor here. That is my duty to inform you of that. So now that we've got all of that, who is talking, who has spent the last couple of minutes, telling you what he's going to deliver for you. And my name is Michael Sullivan. I am a small town Virginia boy. So I heard Raleigh, North Carolina. I heard Myrtle Beach. I even heard some places across the big pond, the Atlantic Ocean. We got Australia and Norway and such. So it doesn't matter. That's the one great thing that they mentioned before we got started. It doesn't matter where you're at. What matters is what your mindset is and how you approach your business. I have lived in a relatively big city for Virginia. I lived in the capital, Richmond, Virginia, for 6 years and worked for a financial institution for 10 years. And I enjoyed that very much, but I did not like the day-to-day grind of having to be there at 8:30 in the morning and not getting off till 5 or 5:30 in the evening. And the last couple of years I was driving and spending about 2.5 to 3.5 hours, depending on traffic, in a car. So I didn't like the commuting. I wanted to come back home where I was born and raised, and I kind of love it. If you're from a small town, you kind of know what I'm talking about. If you've never lived in a small town, then you have the comforts of having everything at your fingertips. So don't take it for granted. Yeah, yes, you can complain about the traffic, but that there's good and bads, pros and cons with everything. I did go to Old Dominion University, and that was back in the 90s. I graduated from Old Dominion, and like I said, went to corporate America for the first 9 years of my life. So I was in a cube hell, and I love my trading job now. It's funny when we're sitting in a cubicle, you've got your computer there, you've got your filing cabinets and everything. I look at more computers now than I did when I was in the IT world, but I'm looking at stuff that's interesting to me, and I'm looking at it on my own time. So if at 2 o'clock in the afternoon, if the markets are dead, I get up and I go do something else. I can go run errands if I want to, and then I can come back to the markets. They're always there. So the great thing is the flexibility. So I hear you on that. In 2004, I started looking at trading as a profession. I made my first options trade in 1999, and that was the tech bubble, where I thought for the first year, I thought a monkey could make money in the market from 99 to 2000 before the tech bubble burst. I thought I was a genius, and then I learned real quick that risk management is more important than what you make, because we all know what happened in 2000, 2001, and then we also if you weren't around for that, you hopefully, were at least aware of what happened in 07, 08, because the interesting thing is that the market's cyclical. You will get these events that will humble you from time to time, and that's what we've got to watch out for, and what I'm going to try to help you avoid in the presentation today is those events that flat out just, hurt your trading account. I did co-found TradeTheSystem.com in 2005, shortly after 2005, and I've been a trading room moderator. I think this is the 9th year. Now that we're in 2016, I probably need to update these slides. So the funny thing is that it wasn't until I came really comfortable teaching that the profits or the income started really building on itself. Because if you can get in front of a group and explain, I like to say explain to my child how I'm going to do in the markets, it's only then, when you have mastered your setups and your belief in the market and the ability to act in a consistent manner. So for the last 8 years, I have enjoyed the freedom of being a professional trader, and would like to, hopefully share that with you today and help you become or get to where you want to be. So before we get into the meat of the presentation, there's a couple of things that I need to ask you, and you guys are going to say, the meat of the presentation is probably more important. What settings am I using on the charts are more important than your mindset? But I'm here to tell you that your mindset is the most important and the biggest asset you have. So I know there's a great speaker lineup coming on today. I know they're going to give you a lot of X's and O's, but I don't want you to lose the fact that you've got to answer this question so that you know why you're sitting here looking at these X's and O's. I sacrificed 18 months of my life and 18 months of the first, 24 months of my child's kind of coming into this world. I wasn't an absent father, but I wasn't as involved in my kids when my first one was 18 months old as I am today. And was the sacrifice worth it? If something would have happened to me, 10, 11 years ago and I wasn't here today, I would say that sacrifice is not worth it. But it did get me the flexibility to get to where I am today. So in that perspective, yeah, the last 9 or 10 years have been well worth the short-term sacrifice. If I had it to do over again, I probably wouldn't spend 18, 19 hours a day in front of a computer and completely shut off the world while I was learning this profession. I would keep my day job. So if some of you are still in cubicles or some of you still have day jobs, I would keep that day job and I would allocate, maybe a good 2.5 hours per day. And yes, that makes your work day, instead of 8 hours, it makes it 10.5 hours. But don't sacrifice the things that are most important to you in order to, to get here, a couple of months earlier. The markets are going to be here, and the things that I'm going to tell you will help you condense that learning curve that I had to go through dramatically. But if you don't have this question answered, how big is your why? And I stole this, I'll freely admit that when it comes to trading and when it comes to self-help, a lot of people beg, borrow, and steal. And so I stole this from one of the Tony Robbins presentations. I don't know if you guys are into big self-help. I'm not a huge fan of any one individual, but I do love the quotes, and I do I practice what I preach as far as telling people to do what that I do. And so I do beg, borrow, and steal very good quotes to try to keep me motivated and to keep me focused. And one of the questions was, how big is your why? And there's a couple of words that are highlighted here. How big, how much do you want it, and because it doesn't matter what drives me. I'm about to show you what drives me, and it really does not matter at all. What matters is what drives you. But if you never ask this question, you're never going to get there. So when you ask yourself, how big is your why, the interesting thing is, I talked about the indicators and things, they don't matter. Because when your why is big enough, the how becomes easy. The how stares you right in your face, okay? And for some of you, when you go through this exercise, when you ask yourself, how big is your why, then you're going to come to the conclusion that trading may not be for you. And that's fine. I mean, maybe you're just not driven enough to succeed in this market. I like to think that we all are, and we all have the ability to be. And I think with the right training, I do think trading is an acquired skill. I don't think you have to be born to be a trader. There are a lot of books on psychology out there. Do you have to be born to be a trader? No, I mean, but you have to have discipline. And what's going to give you that discipline is your why. Why you're sitting here doing this, okay? And this is my why. Now, with the intro, it mentioned, I forgot to, evidently my staff sent an older bio, because you can see this guy right here is no longer 5 years old. So evidently, I do apologize for that. To the guys at Winvesting, we did send you the wrong bio. Evidently, they sent you an older version. I do have a 10-year-old now. So that was, this is Jackson, the one that they were talking about in the bio. This is Carter. Carter is 4 years old now. And this is my wife, Jennifer. And this is why I trade. I don't get to go to the beach with them and get away from work. I don't get to spend time growing up in the country with, tractors and things like that with my two boys, and have them grow up away from the big city, away from a two-bedroom apartment, with all of us crammed in there. I get the luxury. We live on 27 acres of land, and I built my retirement home, back when I was still in corporate America. So I consider myself retired now. And the funny thing is, I work harder in retirement than I did when I was at corporate America. But it doesn't feel like work, because it's on my own time. and it allows me to spend time with these guys, which are the most important things in my life. So when I answered that why, I knew what I was looking for, and I didn't care if I made $25,000 or $75,000 or $250,000 a year. I knew what I needed to do to make sure that I didn't have to go back to that corporate grind, and I could spend time growing up with these two, because they're only young once. And if you don't have kids, that's great. You've got passions that you need to put on this slide. You need to make, and one other housekeeping issue. Dan talked about taking notes. There is a camera button in your right screen, so you can put your pens down while I'm talking and just hit the camera button, and that'll take a picture of what's ever on my screen. So I meant to say that at the beginning. And when you're sitting here trying to write feverishly, sometimes you miss things. Don't worry about writing. If it's something on my screen that you want the settings for, you just hit that little camera button in the right. So let me go ahead and just finish up with these guys. Trading has allowed me to coach the travel baseball team that my son plays on. My golf game has taken a little bit of a hit because of this, but it's what I want to do, and that's the key thing when you're trying to become a professional trader, is you get to be on your time. And so that's the little background of who's talking to you right now and who's going to kind of be talking with you for the next few minutes about what you need to focus on. And the reason that I do this is because I want other people to be able to attain that flexibility that I think is so important in my life. So let me go ahead and stop for a second, and before we get into the index futures, while I'm telling you what index futures, what this presentation is going to benefit you in trading and what it's not going to do for your trading, can you guys please post in the little chat window, and I can see the questions now, so if you would just post two things for me. I already know your names and I already know where you're from, but I need to know whether you're a day, swing, or long-term investor. That's the first thing I need to know. And then the other thing I need to know is what instruments you trade. If you trade stocks, options, futures, or other. I know that there's binary options and things like that. Because the interesting thing that I'm going to talk to you about is I'm not going to help the people who are typing in swing trading only. You're going to be able to refine your entries, but you're not going to get the full gamut of this presentation. It may be a little bit over your head. A lot of people are saying options and futures. For you guys, this is going to directly benefit you. And if you're trading ETFs, I see a couple of people actually being specific. Thanks, guys. You guys are being real specific about ETFs instead of just stocks or equities. So ETFs, they have changed trading a little bit. I'm going to show some futures charts, but when I'm talking about index futures, when I'm talking about trading index futures and these clues and secrets on trading the index futures, it applies to anything index related. So if you're trading NDX options or SPX options, or if you're trading ETFs like the spiders, the diamonds, the IWM, or what's changed the game is those leveraged ETFs. So leveraged ETFs are, a great little day trading vehicle, right? Because they're for 2 or 3x the amount of move that you get. Now, leverage is an interesting thing. It's a double-edged sword. If you use it correctly, it's great. It will help $10,000 accounts become $20,000 accounts, and $20,000 accounts become $40,000 accounts. But the thing about it is, if you don't know how to use it or you abuse the leverage, it can make a $100,000 account a $20,000 account real quick. So be careful there and kind of make sure you're trading appropriate risk for your portfolio size throughout anything that anybody teaches. Make sure you control your risk. So that's what I'm going to be helping you with today. I do personally, I trade gold, crude oil, the 30-year bond, corn, soybeans, and the index futures. My bread and butter is the index futures. Hands down, without question, the index futures are what I have the most information on, which I'm going to share with you today, and it gives me the best edge to play with. Now, Crude oil moves a lot faster, and some days I make a whole lot more money trading crude oil than I do the index futures. But if you're looking for that consistent return, that consistent, where can I find that $150 to $300 a day in income and grow that? Obviously we can control our position size. So that if you can get consistently making $150, well, guess what? We're the CEO of our company. So you know how you make, if you're consistently making $150, anybody know how you make $300? You just trade more contracts. You don't change your trading. That's the key to this. You control your risk. You start a consistent level that you make. You may make $50 a day. I don't know. You may get good at making $50 a day. You may get good at making $300 a day. It doesn't matter, because all you do is you've got to get consistent, and then you give yourself a raise by increasing your contracts, scaling in. Exactly. As you prove yourself, as your performance warrants, you give yourself a raise. And that's the wonderful thing about trading. We control that. So let's get into the meat. Let's dive kind of head first into what we're talking about here. And again, don't forget that camera in the right-hand side of the screen. And when I throw up a chart that you want to kind of take a picture of, or I make a note, take a picture of it, save it to your desktop after the presentation, print it off, and that'll keep you from having to write feverishly while I'm trying to talk, because I am going to go pretty fast through this stuff, and we'll get to, like I said, the meat right now. So the troubles with index trading, and anybody who's traded ETFs or futures, and the futures that I'm talking about are the Dow, the S&P, the Russell, or the NASDAQ. And there is a mid-cap out there, I think, that the CME put out. I forget what the ticker is, but it's a mid-cap 400. I don't even trade that. It doesn't have enough volume for me to worry about. So the main ones I'm going to talk about are those four: the Dow, NASDAQ, Russell, and the S&P 500. So the common pitfalls in index trading, okay? The common pitfalls. You see the markets, and we've got a little situation like this today where we've gapped down. Well, there's two strategies, right? There's long and short. Some people are going to tell you, hey, if it gaps down, the gap's going to go fill. And so if we see a gap down, we go long and we try to get the gap filled. And some people are going to tell you, oh, well, when the market gaps like this, it's a professional gap. It's a pro gap. The professionals are taking it down, and it's going to crater. And the interesting thing is, both are right. Both of those. Sorry, you don't see the camera. Okay, if you're not seeing the camera, then you're going to have to write feverishly. So it should be. I thought the camera button is normally in the right hand corner of the GoToWebinar screen. If it's not there, then you can take notes. But you do have a recording coming up, that the guys are going to get out to you. So don't worry about it too much. It is there. Okay, yeah, top right corner of your GoToWebinar window. Is where it's going to be. It's not going to be on my particular screen, but it's going to be on your application. So let me go ahead and kind of keep going here. Both people are right when you start talking about the gap fill. The thing about it is you got to take it to the next level. You've got to know which gaps have a tendency to go up and fill and which gaps have the tendency to go down. And that's what makes it so difficult, because look at this price action. I'm going to zoom in right here where my cursor's at on this first red candle on, happens to be October 19th, because this is a great example of what the markets will do to you. So everybody knows basic candlesticks probably, and this is an up candle because it's hollow. You've got the open, and you go down a little bit, and then you go screaming up. Well, why do we do this? Why do the candles look like this? You've got to see this in the trader's mindset, or the trader's psychology. So most people have been taught those strategies that I just talked about. So what is the market going to do? It's going to inflict as much pain as it can. So it's going to go up to suck all the people who think the market's going to the gap fill. It's going to try to get them long. Once it's done that, by giving a few people a good entry, a few people a retail entry, then it's going to kind of go down. It's going to test their, I like to call it the intestinal fortitude. It's going to test the market. Is going to test that trader's commitment to that level. And what it's going to do is going to run down. And guess what's going to happen in this tail? it's going to stop out most of the people that got long right up in here expecting it to go to a gap fill. And it's going to go down just enough to make the people who think it's going to be a professional gap get short. And about the time they get short, guess what's going to happen? The market reverses and it starts coming back up here. Have you ever sat there in the markets and you've taken a position and immediately it goes against you? I know I have. And that's what's going on. The market's trying to figure out where it's going to inflict the most pain. And yes, that's a cruel reality. But once you accept that and you know which game you're playing, you stop worrying about these short-term fluctuations. You put your position on, you define your parameters, and then you take the trade. Now, look at the psychology of this. It goes up, it makes a straight-up move all the way to about the 50% gap fill. Then it starts doing that, you know, oh, I'm going to sucker these people in. Now they've been stopped out. We've gone up enough to get them back excited about going to the gap fill. So, and then we're going to pause. We're going to start coming back. And then we're going to go up, and we're going to make new highs, and then we're going to take out the lows. And then we're going to come in here, and we're going to consolidate. We're going to head fake you to the high side. We're going to pull back. We're going to act like we're going higher, and we're going to break the lows. The markets love to do this. And I don't know if any of you guys have ever had this experience before, but if you have, you know exactly what I'm talking about, the indexes. Crude oil, you don't really have to worry about this as much. Now, there are times that crude oil will do this too, but it's not as famous for doing this as the indexes are. Okay, and that's what the indexes, that's kind of the nature or the personality of them. Okay, another thing that we've got to watch out for and our trouble with trading the indexes is a lot of people like to teach indicator-based trading. Okay, they like to teach indicator-based movement. And I've got just a simple MACD. Just about everybody looks at a MACD in some way, shape, or form. And when it crosses to the downside, and goes to the zero line, we're taught, oh, look for shorts. And then when it crosses to the upside, oh, we're told to look for the longs. You got a green histogram here. Well, look at the problem with that logic. You've sat here, and when it crossed back here, it grinded and grinded and grinded and made new highs. And about the time you gave up on this thing going down, and you said, well, shoot, I'm going to buy this thing instead of, trying to sit here and wait for it to go down because the market's so strong, it comes back and you miss the best move of the day. Then you come down here and you say, well, I missed this. I'm a disciplined trader. I'm not going to chase after the market. So you wait and you get that green on the histogram. You get that MACD crossing. You go long. Well, look what happens in the markets. You come down here and you go sideways for 30 minutes. That's an eternity to us day traders. And it makes a new low, just enough to get you out, just enough to check your belief, and then it kind of goes up in the direction that you thought it was going to go based on the MACD cross. Indexes love to do that. Charts love to do that. What it does is it shakes your confidence. All of these false signals when you're trying to get long and it's not going anywhere, and then it makes new highs and you just can't get any traction. All of those signals, all of those problems or issues in timing your entry lead to a lack of confidence in your trading plan. Okay, you sit here and the thing about it is if you came in here and your mindset, your 2016, your trading goal is to follow your plan, right? You're sitting here and you say, well, I'm a Russell trader. I'm gonna trade the at TF, and you come in here and you get long and it doesn't go anywhere. You get long and it doesn't really go anywhere. And you get long and you get stopped out. And then about the time you say, man, I've got to reevaluate my plan. So I'm not going to take this signal right here. And then it goes up, 6, 7, 8 points in the Russell. You took the first 3 trades, you followed your plan, you hit your daily stop loss, and then the market takes off in your direction. Your trading plan, the confidence that you have in your trading plan is probably at the lowest it's been in all of your testing. It's not your trading plan, it's your timing of your entry. Because your trading plan is probably correct. Eventually the market will take off. But in the futures or in the index ETFs or anything like that, we've got to see what's going on in order to try to get this thing timed to where we can get through this. Okay, we can sit through some of this and have the market get in our direction. The last thing that I'm going to talk about as far as trouble goes is the overbought, oversold myth of the indicators. So here's a CCI. I don't know if you guys are familiar with these. Like I said, these are not important. What you're looking at is when the indicators go oversold, you're taught to buy the market or look for buying opportunities. Well, that couldn't be further from the truth, because look at this. The best move is once the indicator hits oversold. Now, I'm not saying as soon as every indicator hits oversold, you go in that direction and chase after the market. But we need to time our entries a little bit better. We're timing our entries. How do you read these? What sense do you make? I think indicators are a great mechanism if the conditions are right. And that's what I'm going to talk about today, is when the conditions are right for using the indicators. So you can use the MACD crosses. You can use the CCI, overbought, oversold, but you can't take every signal, okay? So let's go ahead and get into when do we use the indicators? When do we listen to what they're telling us, right? And that's pretty much how I gain an advantage. It's because I look at these market internals, or these hidden indicators that a lot of people don't use and don't look at. I use those to tell me whether to trust the indicators or not. The first one I look at is the ticks. And if anybody, depending on what charting platform you're on, the ticker symbol is going to be $TICK, okay? And I'm going to explain exactly what the $TICK is. The $TICK is the value which represents the number of stocks trading on an uptick versus a downtick. All you have to have for this is the data feed of the New York Stock Exchange. Okay, this is a New York Stock Exchange metric. And I think for me, it cost me like $1 or a couple of bucks per month to have this. And it's available through whatever charting platform. Some charting platforms throw it in for free. But just throw in $TICK. If it doesn't work on your platform, you're looking for the New York Stock Exchange uptick versus downtick metric. Okay? So, and I know in the major platforms, in Thinkorswim, Sierra Charts, TradeStation, eSignal, the $TICK will work. Some of your retail brokerage platforms like a Charles Schwab or something like that may or may not have this, but you're behind the 8 ball if you're trading through a platform like that. If you're trying to be a professional trader, then you need to make sure you're using professional platforms, and that's a discussion for an entirely different time frame. What we're going to focus on here is explaining the ticks to you and how you use them to your advantage. The key values, when you're looking at the $TICK, you're not concerned with every single value. You're concerned with plus or minus 1,000, plus or minus 800, and the zero line. And when I'm talking about this, I'm going to show you a picture here in just a second. An example is like when 2,300 stocks on the New York Stock Exchange are trading on an uptick. In other words, the last print was on an uptick. They're gaining momentum. They're trading on a positive number. And 2,100 are trading on a downtick. The tick reading that you're going to get is plus 200. You're going to see plus 200 on your chart. And that means you got almost an equal number of buyers or aggressiveness. From an aggressive standpoint, you've got almost an equal number of buyers and sellers, okay? The guidelines for trading it, and I'm going to show you, like I said, the picture in just a second. If the ticks, I told you, but the zero line is very important. If the ticks spend most of the time above zero, forget about counter trend trading to the downside. There's no need. You're fighting the current. You guys know when there's current in the river, or current, they call them rip tides in the ocean. When those things start taking you, the general consensus is you let the river or let the tide take you wherever it's going to go. You just float with it, okay? Because if you try to fight it, you'll end up drowning because you'll tire yourself out. There's no need to fight the current. You let it take you wherever it's wanting to go, and then when you get out of that rip tide, when you get out of that rip current, then you can use your energy to try to swim to safety. Okay, if you sit there and fight the current, one of two things is going to happen. Either you're going to be strong enough to break the current because the current's not, strong enough, or you're going to get worn out. And it gets tiresome trying to constantly fight the market. It really gets tough. It drains on your psychology. So if you've got the ticks the first hour, if they've spent all their time above zero, buy the next little dip in the market. If the ticks are most of the time below zero, short the market. Don't worry about going long. The riptide or the current is going to the downside. Just go with it. Okay? There are the couple of levels that we need to be aware of, though. The first couple extreme readings. Now, I'm considering an extreme reading plus or minus 1,000 on the ticks. The first one or two of those, that's when the market can be exhausted. If you think about the ticks as an RPM gauge on your car, if you've got an RPM gauge on your car, your tractor, or whatever, that RPM gauge tells you, how many revolutions that motor, those pistons are going up and down. So it's telling you, okay, if I'm sitting here, and I like to think of a race car analogy, like in NASCAR, if that car is turning 9,000 RPMs, it can go around that track 500, 600, 700 times without worrying about blowing up. But when it gets to above 10,000, that car is going to not make it those 500 miles. It can hold 10,000 for a while, but eventually it's either going to overheat or one of those components are going to break. Same thing in the market. The market can grind higher and higher and higher if you're just sitting there at 600, 800, 900 ticks. But when it gets to 1,000 or 1,100 ticks, it can't maintain that velocity for the entire day. I've been trading 10 years. I've looked at markets for about 30 years worth of historical data. At no point has the market went to 1,000 on the ticks, shot up, and kept going up for the entire day. You've got a window. Sometimes it's 1 minute, sometimes it's about 10 to 15 minutes. That market is going to run out of gas. It's either going to stall out or it's going to completely reverse. Okay, so use that to your advantage. There are places where we need to be disciplined. If the ticks get above 800, you've missed the move. Don't try to initiate new positions if the ticks are above 800 to the long side or below 800 to the downside. Okay, you wait until the ticks have retraced a little bit, and then you get a better entry. It's what I call retail trading versus wholesale trading. Look for the wholesale entries, not the retail entries. And if the ticks are above 800 and you're trying to go long, you've missed the move. You don't have, there's not a whole lot of meat on that bone left. Okay, so use the extreme readings around swing highs and swing lows to exit your positions. This is not only for timing your entries. When you get in a position and you're fortunate enough to get profits and you see the market getting exhausted, don't be afraid to take your profits. Okay, don't be afraid to take your profits. Now let's talk about what this looks like. Here's what my tick chart looks like. My tick chart has a red line at plus 1,000, a dotted line at 800, a white line at the zero line, and negative 800 and minus 1,000 have the corresponding colors. Why do I put the colors on here? Because I know that the only trades I'm going to enter when the market is at plus 1,000 is to the short side. I'm exiting a long position and taking profits. The green line represents areas that I want to buy on the charts. Okay, now the interesting thing is this zero line. A lot of people think, oh, well, if it's above zero, then I need to be taking every little time it goes above zero. The zero line is your gauge to determine who's in control for the first hour. Okay, when you sit here and constantly straddle the zero line, if you go down here to plus 400 or up here to plus 400 and then down here to minus 400 and you sit there and go back and forth, that means nobody's in control of the market. You're more than likely in a range-bound situation. So you don't want to employ trend-following strategies during that time. What you want to do is when you've got the ticks one-sided, you want to use the zero line as support. So if in this chart, for instance, I'll just give you a little hypothetical here. Let's pretend this stuff on the right doesn't exist. When we're coming down, all the information I've got is that the ticks were at 800. So when we get to the zero line, this area is purchasable because I don't have any data saying that the market's going down. And more than likely, if you were patient enough to get this entry, when the ticks got up here to between 800 and 1,000, you were able to make some money. Okay? That's why these things are so important. That's why it's paramount. It's absolutely critical. If you're an index trader or an ETF trader, or trading market proxy stocks and you're trying to time your entry, you better be aware of this because it's a really big deal. Here's a chart that is a 1 minute tick chart, and that's what I watch this thing on, is a 1 minute time frame. Here's my tick chart, and I put price down here at the bottom. So you can see price is rolling, the ticks are above zero, but when this move takes place, we hit plus 1,000 on the ticks. The market is not going to sustain this time frame. It's not going to sustain this velocity because it can't. There's nobody left to buy. There's nobody left to buy. I did forget to mention the white line. Here, this white line right here, I like to look at where, like a line on close view, but I don't want to take up too much space on my screens. So what this is a 1 period moving average, and it gives me the exact same view as the line on close. Okay, so basically I've got an open, high, low, close bar on the tick chart that gives me the highs, lows, open, and close, and then I've got a 1 period moving average. It doesn't matter what kind of moving average because it's a 1 period. So an EMA and an SMA on a 1 period time frame are going to be the exact same. And so what you're doing is you're looking at the line on close to give you kind of a trending look. Instead of the absolute highs and lows, it'll tell you, hey, when is this thing done? Okay, because we're headed back up. So that's all that is. It's a 1 period moving average. So we get up here to the 1,000 on the ticks. The market starts to drift, and it pulls back. Notice, technically, you're just at a support level, but you were able to time your entry where you were actually to make money to the downside, 30 points around 30 points in an uptrending market because you knew not to get excited and buy at the retail level. Okay, you're timing your entry at the professional level or the wholesale levels. And then when it gets down here, you got down to this negative 800. If you go from one tick range to the other tick range, that's when you want to take profits. Now notice this is not the absolute low, but it does consolidate and it does give you the meat of the move. And that's what we're after. We're after the meat of the move. We're not trying to call both tops and bottoms. We want high probability areas where the market's about to turn, and we want to cover in positions that the most of the easy lifting, quote unquote, is done. Because right here the market is fighting. It's fighting to go up, it's fighting to go down. And we don't know which way is going to win. But we do know that if we can short right here and cover, and it doesn't have to be right here, you can move your stop down right here. And then as it makes new lows, you can evaluate the ticks. Okay? So that's how powerful this particular chart is. If I could only have one chart in my trading, this is one of the charts this is probably the most important chart. I'd like a time and sales window, but I would have to have one of my tick charts. It's for all indexes. It's a New York Stock Exchange metric. So you can use this tactic for the Dow, the Russell, the S&P, the Spiders, the Qs, or any market proxy stock. This will help you get a better, a wholesale entry level rather than paying retail for things. And we all like to find good deals. Okay, let me grab a quick sip of water. All right, so that's the ticks. And now we're going to move on to another market internal or another hidden secret. This one's not as complicated. The ticks are the most complicated thing that I'm going to go over. I could actually spend the whole hour on just the ticks if I wanted to. The rest of these are pretty cut and dry, these next 4 secrets. So let's look at the volume spread. Now, this metric is only for the S&P 500, but since the Dow and the Russell and the NASDAQ are so correlated to the S&P 500, this metric can be used to trade all index futures or all index ETFs. Okay, so just because it's looking at the S&P, remember the S&P is the 500, S&P 500. That's bigger than the Dow 30. That's bigger than the NDX options, which measure the NASDAQ 100. So it's going to encompass more data than your others. Okay, so don't worry about the fact that this is the S&P volume spread. Just know that it's a market internal or a hidden secret to trading the index futures. Now, I'm starting off with the chart that probably looks the worst, because the next chart I'm going to show you the difference in when you want to trade and when you want to sit on the sidelines. Look at this chart. If I didn't have this white zero line here, which way do you think the market is going? Anybody? Up or down? Up or down? And there is no wrong answer. I mean, I'm not going to kill you, because it all depends on your view of the markets. But all right, so some people are saying up, some people are saying don't know, and some people are saying sideways. So the good thing that we have is nobody said down, right? Nobody looked at this chart and said, oh, the market's getting ready to get killed. If you've got the volume spread, which is the S&P differential, it's the up volume of the S&P 500 minus the down volume of the S&P 500, okay? If you've got readings that are not getting away from the zero line, you're not going anywhere. So you don't have to worry about being in the market. Look at this chart. Look at this price chart. From 11 o'clock to 1:30, did you miss anything by not trading? Absolutely not. It went dead sideways. And it was very evident in the volume spread. Now, in the morning, we talked about the little head fake to the downside. The volume spread bottomed out, and then it took off. It crossed the zero line and started trending. Up until this point, you're still making new highs, right? So we've got a sideways market here when the volume spread can't get past the zero line, okay? Now, on the next slide I'm going to show you is when you do want to trade, okay? You do want to trade when you have a situation like this. Look at the difference in the chart. You started trending higher, so you have a idea that the market is going up. You pull back, you don't quite hit the zero line, and then look what happens to the volume spread. It makes a new high or a lower high, but it breaks that. It makes a newer high, a higher high. It makes another higher high. It makes another higher high, another higher high, and it just keeps making higher highs. Don't you think at some point in this chart you could find an area to buy? Because you've got from 12 o'clock to 4 o'clock to focus only on the long side of the market. Now, I've already taught you how to use the ticks. So if we see this type of chart that I just showed you, and then we see this tick chart, well, guess what? This would be a buy point, would it not? You're down here in the lower part of the tick range. I've already told you the ticks aren't going to stay down here forever. Or if we're right here in the ticks, you can buy the zero line. Okay, now these charts don't match up. I'm just going back to give you ideas on how to put these two things together. Okay, so you would know by the volume spread which direction to trade, and you will know by the ticks when to time your entry to the long side. Okay, and when you see a chart like this, when you're up 300,000 on the volume spread, you know your ticks should be positive. Will 100% of the time will it be positive? Not 100% of the time, but pretty close to it. And you just wait for the little tick hook to the upside, which I didn't explain that in detail, but you saw that one period moving average, how it creates a hook. You use the tick hooks and you try to get long. You time your entry at one of these little pullbacks, and that's the difference in being a wholesale trader versus a retail trader. Okay, so determine your direction with the volume spread. This gives you the direction where the market is likely to continue heading, and then you can time your entry with the ticks. Now, this next indicator, it's the ARMS index. It's $TRIN. And I'm going to have plenty of time for questions at the end, guys, but let me get through this material first, and that way I make sure I deliver all the secrets that I want to give you, and then, like I said, we can come back for a Q&A. So we've got the $TRIN. This is not a market direction or anything. This has a specific use. This is a little-known secret to timing a specific trade that has a positive expectancy, okay? And that's what it's all about. On your trend chart, your $TRIN, it's referred to as the ARMS index or the traders index. What you want to watch out for is you want to look when the market is trending down or struggling sideways. This is a one-direction trade only, and you get the first test of 1.5 on the ARMS index or the trend, the $TRIN. You want to look for a bottom in the market. You want to look for the selling to lessen, and you want to look to get long at 1.5. And if the market is in a bloodbath day and it keeps going down and down and down, then you can try 2.0 as well. But the sweet spot is 1.5 because there's two trade setups that I'm going to tell you about in this one indicator. Number one is the first time it hits it. Now, if it hits it and keeps on going, you'll get stopped out. That's called a losing trade. We have those from time to time. Anybody who trades is going to have those for, every now and then. But when it hits the 1.5 level, you're looking for a long signal. Once again, go back to your ticks for your entry, go back to a price pattern, go to your volume spread and wait for it to bottom out. Whatever you want to do to time your entry, just stop looking to short the market when you get to 1.5. Now, if it consolidates and then goes lower, by all means, you can take some shorts once the trend levels out. But the trend at 1.5, the market is going to lose some of its velocity to the downside. Why, you may ask? Don't question it. I don't know. It's just the calculation lends itself to when it hits this level, most of the people who wanted to short the market have been short, okay? And there's nobody left to short the market. It's sort of like that RPM gauge on the ticks, but this is just a value on the trend. Now, the other thing that I want to tell you about the trend, if at 4 o'clock in the afternoon or at 3:58, because you got to have time to enter the trade, this is a great little options play. So for those of you who trade options, the NDX options or the SPX options or the spatter, or diamond options or spreads, if you see at the end of the day the market at 1.5 or higher at 3:58 in the afternoon, it is a good time to buy some call options and flip them out the next morning after the market's gapped up. Not a 100% setup, but if you take 10 to 25 of those trades over the course of the year, you should, have more money in your account than you lost. I like options in this arena rather than futures because I can control my risk. I can put a diamond spread on here, a call spread that limits my risk. Heck, you guys know if you trade any of the options, I think they are in 50-cent strike increments. So you can control your risk. You can go a 2 or a 3 wide spread. You can control your risk to like $100 or $150. Real low risk trade, and if it gaps up, you've got a chance to make some money. Okay, so really risk control trade. Another thing you can do for your futures traders is you'll see this value up there at like 3:45. Well, from 3:45 to 4 o'clock, you can try to get in the market to the long side, have a little short covering rally into the close, sell half your position at between 4 and 4:15, move your stop to break even, and see if the market will continue for you. Really interesting little couple of trades that I look for, each day, and especially at the end of the day. I love the overnight trend trade. All right, secret number 4, ADX. I've talked about when it's good to trade and when it's not good to trade. Here's your switch, if you will. And this is, like I said, the secrets get faster because they get a little simpler. The ADX, it doesn't get a whole lot more simpler. I'm on a 2-minute day session chart. You can be on the Dow or the S&P or the ETFs, whatever you want to be on. But you want to be on a 2-minute time frame for day trading. And if the market goes below 20, you want to stand aside. There's a less of a chance of a trend developing, while you're down here than when you're up here above 20. I can't get much more straightforward than that. ADX is an indicator. You put it on, all I've done is hidden price. I hid price on a 2-minute chart. So this is a 2-minute, this particular chart's a Dow chart, but like I said, it doesn't matter. You want a 2-minute time frame to give you a decent look at the trend. Put the ADX, it's a 14-period ADX, and then when it goes below 20, you need to trade with caution. Trade, watch where you're entering trades, because this is the area when you're below 20 that traders tend to overtrade. Traders tend to put too many trades on and end up churning their account. Okay? So, quick summary, these are building blocks. They build on each other. If the volume spread is trending up and making new highs, the ticks are positive, and the ADX is above 20, by all means, go long. You know, try to time your entry and try to look for longs or shorts, you know, if the evil twin is present. If you've got the volume spread not wanting to leave the zero line, if it's going up and coming back to the zero line, going down and coming back to the zero line, and the ADX is below 20, I don't care what the ticks are doing. It's a dangerous time to trade because anything you get into, the market has a chance of chopping you up. Okay? Sometimes it's not when you trade, it's when you don't trade that makes you profits. Because if I can wait for the market conditions to be correct and be in my favor, and my winning trades are not making up for losing trades, they're actually adding money to my account, that is a big deal. That's a huge deal, okay? Especially to day traders and you know, short-term swing traders. Not being wrong is just as important as being right. And knowing when not to trade is just as important as knowing when the market is set to move. And, you know, yes, there's sometimes that the market takes off and you're down here below 20, and that's just going to happen. If the move is strong enough, you'll see the other internals go into your favor, and you'll have a chance to get involved in the market. Okay? The last secret is the advanced decline line. It's $ADD. This is a confirmation secret. And basically what you want to see is you want to see this chart in conjunction with the volume spread. You want to see them agreeing in order to make sure the market has enough strength to keep going. The key levels in this chart, it's not 1,014. I put that on here just to see if you're paying attention. It's not 1,014. That's supposed to be 1,000. Right before I took this screenshot, my cursor hit that line, and it moved it just a little bit. So it's plus 1,000, minus 1,000, plus 500, minus 500, and the zero line. Anything between these yellow lines, it doesn't matter. If you're negative 200, that's the same as being positive 300. It does not matter. It's all choppy. There is no momentum in the market. There is no edge that you're going to gain as a trader. So if you're sitting here between plus and minus 500, you don't have a direction. If you're below the negative 1,000 line or the positive 1,000 line, the market has got better chances of going up than it does coming down, or better chances going down than it does coming up. If you're in between the yellow line and the red line, you have a slight bias. The only way you're going to trade to the downside is if all the other internals are bearish. If you're between the yellow line and the green line here, the only way you're going to trade to the upside is if every single one of your other hidden secrets is bullish. Okay, so this is more of a confirmation indicator. This is something that if you've got the ticks pointing one way and the volume spread and the ADX pointing another, this is your tiebreaker. Okay, this is your tiebreaker. It's the advancing versus declining issues. The ADD stands for advancing something or another. You used to have to use a calculation, but they made it nice and a nice little symbol. It's the advancing issues versus the declining issues. And again, this is a New York Stock Exchange metric. So this is going to measure stuff on the New York Stock Exchange. It measures the strength of the New York Stock Exchange. So where the volume, it's kind of like the volume spread, where the volume spread is doing the S&P 500, the advanced decline line is doing the New York Stock Exchange. Okay? So those are the 5 secrets that I want to really, kind of let you know about, and that's why I like trading the index options. Now, I've got 2 more bonus tips. Actually, I've got one more slide here. So you can see that when they're between plus and minus 500, I just wanted to show you that it is a sideways market. You don't have a real good trend in place, as opposed to, when you're looking, and this chart's not the best example because I don't have price, but this was a bullish day. This was a bullish day. This is a sideways day because it's caught between those 2 yellow lines. So the last 2 bonus tips that I've got for you, and I'm going to make these kind of quick because the offer that I'm going to make you exploits these bonus tips as well. What we've got here for you is, I don't know if you guys have heard, how many people have heard of the term divergence? Have you heard of the term divergence? Anybody heard of Divergence? If you have not heard of Divergence, then it is critical that you don't even trade the rest of the day. Spend the rest of the afternoon learning what Divergence is. Okay, my wife calls me that. That is great. That's great. The ticks. This is a $ tick chart. Can help you spot a hidden secret. This is probably the most powerful secret out there. Is if you can take the $ tick chart. I told you it was my favorite chart. And when it goes above that 1,000 reading and the market does not slow down, don't get sucked in. Look for a divergence setup. So right here, if you went short, depending on your stops and targets, you either scratched or you lost on the trade. The market went sideways and then it made another explosion to the upside. Look at the relationship with the ticks. This one went up to probably 11, maybe 1,100, 1,150. This little tip right here barely made it above the 1,000 mark. That's what we call tick divergence. The high made on the price chart was not confirmed with the high made on the tick chart. Okay? As soon as you see this, as soon as you get that rotation, you see this hook right here on the moving averages, as soon as you see that, you need to be looking to counter trend trade the market. And it works to the downside as well. If you've got new lows in the chart, and they're followed up with new lows on the chart, but not new lows on the tick chart, that move is running out of steam. Your move is coming to an end. You're getting ready to start looking for a top or a bottom. In this case, you can see you didn't get the top here, but you got the top here, and it rolled back to the downside. It did not go higher. Okay? So what you're looking for, trade number 1 is the first one that I talked about. If that one doesn't work, this is trade number 2. There has to be a little time between these two. If this move, excuse me, would have came up and eclipsed the 1,000 reading, then that's still considered that first move. You got to have a little time, and then when the market makes that move and makes that second leg to the upside, that's when you want to look for that tick divergence. And it's present as soon as you get this lower close. Okay, right here on this white line, even though the price has not really given up yet, right here you can tell the market is out of steam. Okay, it signals a top in the market. When you get a tick divergence at the extreme levels, that signals a market top. When you get tick divergence down here at the lower extremes, that signals a high likelihood of a market bottom. Okay, the other tip, there's a strategy, or there's statistics that support an ATR move. You guys have all heard of the average true range. So if you've got an average true range, the dotted line is 100% of that range. That's normal market movement. In between these dotted lines is normal market movement. When you start approaching 120% of the ATR, you start putting stacking the odds in your favor. Okay, you start getting it to where you're more likely to reverse or stop than you are to keep going. So 2 uses, and then I've got to go to some questions. So 2 uses here. If you get short, like on this candle right here, you use these ATR levels as targets. If you miss this entire move, once you hit that 120% of the ATR level, you have to look for counter trend trades only. I'm no longer allowed by my trading plan to go short when we're past those levels. Why? Because look back at this market activity. 95 to 97% of the price is contained within this range. You're not going to close outside of that range very often. Now, are there some days that you close outside of it? Yes, there are. This particular day, I think you closed a couple of ticks outside of it. But look how price stalled when it got to those levels. And all you do is you take this figure right down here on the Dow, the average true range of the 14-period Dow chart, a daily chart, YM daily or SPY daily. You take the average true range and you multiply it by 100% and 120%. And you add or subtract those numbers from the close of the previous day. And that's what gets it to you. That's how you get these lines on your chart. Now, the offer that I've got for you today includes that indicator. So I throw that indicator free, so if you're not a tech wizard, you can still get that indicator. And I'm going to go to questions and answer all the questions that I can as soon as I tell you about what we're doing. I've just told you about 5 specific setups or things that can help you with your trading. And I've also given you 2 bonus setups that I trade on a daily basis. We're doing, on January 13th, I'm doing a day in the life where you actually spend a trading session with me and I go over all of these in a live market setting. So instead of looking at it on PowerPoints, we look at it on a live market and we take trades in a live condition. Now, I can't guarantee, remember, past performance is not indicative of future gains or future, deals. But the last 2 sessions that I did, we made $350 in 2 hours, and we made $270 or $370 and $250. So I paid for the retail price of the course in the last 2 sessions that I've done, and these were recent. One of them was as recent as December. We're doing another one January 13th from 9 a.m. in the morning to 11 in the morning. And then I'll stay after if there are a lot of questions. But we try to get 3 to 8 setups that we take so that you have the things that I've talked about. You have a toolbox where you can use them on a daily basis. Also, I told you about those 2 sessions where we made money. Those were recorded. And you get immediate access to those on demand. So you get a recording sent to you of 2 of those sessions. We sell those for $197 each. The day in the life is $300 or close to $300 to just attend it. Plus, you get that ATR indicator that I just told you about for TradeStation, or I give you the formula in a pseudocode document, in a technical document, a Word document that allows you to put that on any platform that you're trying to put it on. Okay, so you get the free indicator, you get immediate access to 2 of the past trainings, and you get to attend the live January 13th training. The regular price of all of this stuff is, and if you want to pay the regular price, hit it right now. But today's offer, we're getting the live trading session on January 13th. We're getting the on-demand recordings, 2 of those, and you're getting the ATR code. All of that is $591, but since we're doing a multi-speaker event here today, and MarketFest is so good at putting these things on, we're doing it all for $97. So you get the live trading session, the on-demand recording, and the ATR indicator for just one price of $97. Okay, you get a chance to view those on-demand recordings before the live session, and come armed to the live session with any questions that you have about the setups, and then you get to see the setups acted on in a live market environment. Okay, so it's a pretty good little offer. You can get that at www.tradethesystem.com/NOW or /now. All of our offers, well, here's a guy that took one of the classes. He took, I think, the October class, and he said, thank you for the day course. It was a behind-the-scenes look. Okay, and I've talked about retail traders and professional traders. We get the professional entries. We get to see what you're supposed to be doing. He says, I was wondering what I was supposed to be looking at, and I didn't know what I was supposed to be doing on a daily basis. And I talk a lot about the proper mindset in trading, when you're supposed to be trading versus when you're not supposed to be trading. Okay, so thanks, Steve, for that testimonial. It's www.tradethesystem.com/now. One thing, if you've never been to a Trade the System presentation, if after the 13th you don't feel like you got $97 worth of value, I'm going to refund your money. So you've got a no-risk money-back guarantee there. All you do is you email support or call the office. We'll refund your $97, and we want to part, regardless of whether you become a client or a student of Trade the System. We want to part as friends. So I have no problem if you don't feel like you've got $97 worth of value. I hope you feel like after watching the recordings you get $97 worth of value. But if you don't and you're not satisfied, just let me know and we'll refund the money. So once again, the offer is for the live trading session, the on-demand recording, and the free indicator. It's $97, and it's at www.tradethesystem.com/now. That's all I have to offer you now. I'm all yours for questions. So one of the questions is, can we use this for Forex? This is not going, the only way it's going to work on Forex is if you find a correlation between the index futures and like some of the pairs, like the euro currency. If you find a correlation between what the stock indexes are doing and what the euro currency is doing, then yes, as long as that correlation is working, this stuff will work on that type of market. But it's not designed specifically for trading forex. There are other techniques that I use for trading. I only trade the euro and the yen, and I trade them on a limited basis. I don't do a whole lot of euro trading. Do the secrets work during pre-market? The great question, Aubrey. The indicators that I've just shown you only go on the market conditions, on when the New York Stock Exchange is open. So it's pit session indicators. So at 9:30 they start giving you values, and at 4 o'clock they stop. So no, it will not work on pre-market. The divergence stuff, price divergence and the indicator divergence does work on the divergence concept works on any time frame, but the actual tick divergence does not. It will only be when the ticks are active, which is 9:30 to 4 o'clock Eastern. Do the secrets also, do any of them work? Well, bonds is an interesting situation, because bonds have an inverse relationship, right? Most of the time, and that inverse relationship is a little not working too well. So it's sort of like the forex. It's not designed specifically for bonds, but when the correlations are working, then yes, you can use it to time your entries in the bonds. Do I have an ATR code for TOS? Is it available for Ninja? The pseudo code you can get converted for TOS or Ninja, but I've only done the coding for TradeStation. I'll look into that and see how much it costs me, Tom. And if it's very affordable, then I'll make it available to you. Why do you need 97 if your trading system is so successful? It's my time. I'm spending my time with you. My time's worth money to me. I don't make any reservations about saying that. So the advanced decline line was negative 2K this morning. We should be looking for shorts. No, if it's negative 2K, you should be looking for short signals. But remember, you've got that gap statistics, and that's why I like the day in the life so much, because we take it from start. We progress through the gap setups and so forth and so forth. All right, it's 10:30. I've got time for one more question, and then I'm going to be done. I appreciate you guys' time. And what market do you put the 2-minute ADX on? I use the Dow, but you can use the Dow, S&P, NASDAQ, Russell, or any of the ETFs. Just make sure for day trading it's on a 2-minute chart with a day session. So thank you guys so much. I hope I've packed you with some good information, giving you a great start. Once again, that link to buy is www.tradethesystem.com/now, and I hope to see you guys on January 13th. We will pack as much as I packed into this session. We'll pack double that into the next session. So thank you guys so much. And do you have a daily chat session? We do, yes. All right, interesting and refreshing. Thank you guys so much for your time. Thank you once again, Winvesting. I appreciate the opportunity to come here. And like I said, thank you guys for your time. Good trading in 2016, and hope to see you guys on January 13th.